Paid-up additions are essential to creating extra cash inside your whole life insurance policy. Technically speaking, paid-up additions are mini whole life policies that are attached to your main whole life policy. And most dividend-paying whole life policies accumulate paid-up additions through the dividend option to purchase paid-up additions. In fact, in most cases, it's the default option for dividend options, and it is the most optimal way to build cash value in a regular whole life policy. But on top of all of that, paid-up additions have evolved over the years to incorporate many additional features that make them quite versatile and extremely important to the pursuit of building high cash value whole life products. And it's this fact that has placed paid-up additions in the focal point of a lot of discussions about whole life insurance as it is employed as either a retirement income asset or some other sort of wealth building tool. You yourself can electively put a paid-up additions rider on your whole life policy, and this gives you the ability to make use of the additional capacity your whole life policy has to receive premiums up to the maximum allowable premium. This might look something like you can put $10,000 into your policy, or rather you must put $10,000 into your policy based on your death benefit, but you also have the ability to add an additional $2,000 on top of that, bringing you to a total premium payment annually speaking of $12,000. $10,000 is your whole life premium. $2,000 is your elective paid-up additions amount. But this raises a very interesting question that most people ask, and that is, why on earth would I want to pay more money to my insurance company? And that's an extremely reasonable question, and it has a very good answer. You see, life insurance companies are, in many respects, asset managers. They take the premiums that you pay them, and for the most part, they invest those premiums. They earn investment gains on those premiums. And in the case of whole life insurance, mutual life insurance, they return those gains to their policyholders through dividends. Paid-up additions are a way to manipulate the function of a whole life policy that ultimately results in the decision to pay you more dividends. So you can use paid-up additions to take advantage of the accumulation features of a whole life policy and gain more dividends and more guaranteed interest by virtue of making use of the paid-up additions rider. There are three interesting things to note about paid-up additions. First, they have immediate cash value. So unlike your base whole life premium, which could take years to accumulate cash value, paid-up additions create cash value immediately. This means they earn guaranteed interest immediately. So there is a way to augment the absolute interest that you will earn on a whole life policy by virtue of the guaranteed interest payment by making a paid-up additions rider payment to your whole life policy, because having more cash value more quickly means you will benefit from the guaranteed interest accumulation of values inside your whole life policy. Paid-up additions also have a death benefit. So for every dollar that you put into a paid-up addition, you will receive some dollars of death benefit. This might look like something similar to $1 of paid-up additions in creates $3 of death benefit outstanding. It's actually kind of a cool feature to enhance the amount of outstanding death benefit that you have. And it's this fact that causes a lot of contemplation on the behalf of the insurance company in terms of just how much they want to allow you to make paid-up addition payments to your whole life policy. Because while you may not be particularly worried about the amount of death benefit you are accumulating through the paid-up additions rider, the insurance company absolutely is. And they do not want to put you in a position where you have the ability to just buy unlimited amounts of additional death benefit. Take, for example, a scenario where you receive a terminal diagnosis. You know that you're not going to live that long. The insurance company does not want to give you an unlimited ability to shore up all the money you can possibly get your hands on and arbitrage up this death benefit by putting $1 in and getting $3 in death benefit, for example. So there are limits put on the amount of money that can go into the paid-up additions rider on an annual basis, and that is the exact reason why those limits exist. Lastly, paid-up additions earn their own dividends. This means that when you purchase paid-up additions, you are increasing the amount of dividends that you will receive because you have the paid-up additions on the policy. But when the dividends are received, they also will go towards the process of purchasing additional paid-up additions, and those additional paid-up additions will also earn more dividends. So there is a compounding effect that goes on with paid-up additions that greatly enhances the amount of cash value that you can achieve inside of a whole life policy. It's this very reason that we have always told people paid-up additions will not only create a more immediate cash value for you, because as we mentioned, they have immediate cash value, but they will also create more long-term cash value because they will earn dividends that will earn dividends that will purchase more paid-up additions that will earn dividends and purchase more paid-up additions and earn more dividends. There is a great compounding aspect of paid-up additions that you can employ when you use this rider. Now, those are the three very noteworthy aspects of paid-up additions. But in addition to that, when you have a paid-up additions rider on a whole life policy, you generally, not always in all circumstances, but in a lot of cases with high quality mutual insurance companies issuing dividend paying whole life insurance, you have flexibility over the paid up additions rider. This means that you can choose to pay it, but you might choose not to if circumstances warrant you do something else with the money in a certain year. So that flexibility gives you a lot of discretion over the amount of money that you put into your whole life insurance policy in any given year. One of the greatest concerns that people bring up about committing to a whole life policy as a means to plan for retirement is they think in terms of premiums being commitments they must pay every single year, which is very similar to how all other insurance contracts work. And it's very understandable that they would come at it with this mindset. But the reality is, with a paid-up additions rider being a component of the premium that you intend to pay, you have flexibility. You can reduce the amount of money that goes into the whole life policy, and that doesn't upset anything. It doesn't put you at risk of lapse. It doesn't mean the policy is going to fall apart. It just means you put less money into the policy because, in general, the paid-up additions rider has flexibility to it. Some, admittedly, much more than others. So do be careful about this. There's the possibility that your paid-up additions rider may lack a certain degree of flexibility. Doesn't mean you can't adjust it, but it might mean those adjustments become permanent. There are flexible paid-up additions rider and what we generally call level paid-up additions rider, and even level has some flexibility to it, but far less so than the flexible paid-up additions riders do. As I said earlier, your reality may look something like you have a certain level of death benefit, you have a $10,000 required whole life premium payment that goes along with that death benefit, and you also have the capacity to put an additional $2,000 into the policy. You could do that with paid-up additions and bring your total premium payment up to $12,000. If you did that, you would absolutely realize better rate of return, more immediate cash value with the policy than if you did not put any paid-up addition payment into the whole life policy. But what if you could get to a place where $6,000 is your required whole life premium payment and $6,000 is your paid-up additions payment? That makes much more of your premium discretionary, but it also means you have much more immediate cash value. You will grow cash value more substantially because you have more paid-up additions, which are more conducive to cash value growth inside a whole life policy. That is something we spend a lot of time helping people do. And if you want to understand specifically how we go about doing it, or one of the most critical ways in which we go about doing it, check this video out.